Welcome guys to our today's session. In this session, we will be covering the recent cracks in private credit, what has happened with BlackRock's funds and some other private credit funds, and how does it affect to Bitcoin or basically Bitcoin-backed securities like the preferred stocks like Stretch and the other preferreds which are being issued on top of Bitcoin. So the flow of the session would be like first we will learn what is private credit, then uh, we'll go to where are the cracks, and the last point would be BTC-backed credit and the comparison of BTC-backed credit to private credit. So this is basically the start. Now, before understanding private credit, let me like take some basics about Bitcoin and some basic keywords which we will be talking about in the session. So, couple of words: collateral, transparency, liquidity, price discovery. So, uh, collateral, as you all know, basically, if you are taking a loan and you keep something with the bank, that is called as collateral. For example, if you are taking loan against your house, you mortgage your house. So in that case, your house is the collateral. Then comes transparency. So transparency basically is how transparent is Bitcoin's market. Uh, as we all know, because of the publicly available blockchain data, Bitcoin's market is pretty much transparent. Then comes liquidity. In case of Bitcoin, as we all know, it's liquid 24/7, 365. You can sell whenever you want. Even in the Sunday evening or Saturday evening, there is no problem to sell Bitcoin. And the last thing is price discovery. I think price discovery in general, people who are not from finance background, they might not have an idea about price discovery, but in general, price discovery is basically something which is related to the market. So in case of Bitcoin, because markets are uh, like continuously on, like there is no holiday in Bitcoin's market. So price is decided by the players in the market, and that is called price discovery. But in case of private credit, price discovery is not usually done by the market. It's usually done by the people who run funds. So in case of BlackRock's fund, the price of that fund is generally calculated by the guys. They have some methods to calculate the NAV. They call it NAV. So if there is a mutual fund, the smallest unit which you can own is called as NAV. For a company, the smallest unit which you can own is called a share or a stock. So yeah, this was basically about some things which I wanted to discuss before diving deep into the private credit. Now, coming to private credit, what is private credit? Why does it started? And why has it become so big? So uh, basically, in 2008, financial crisis took place and banks started collapsing. Because of this, what happened is uh, some uh, uh, the regulator, basically Fed and the other regulators like Basel, so they started to Basel, to the people who don't know, is the the regulator which regulates banks. So uh, they started to they made it very difficult for banks to again do some lending for getting much higher interest rates. So basically, understand it like this: regulators made it hard to uh, uh, made it hard for banks to take risky loans on their balance sheet. Because of this, what happened? And also on the other side, because of the 2008 financial crisis, interest rates started to go down and they settled at near zero because of whatever happened. The economy was in recession, and in the fiat world, what the central bankers do is basically decrease interest rates. So two things happened simultaneously. Banks were not allowed to take risky loans on their balance sheet, and uh, interest rates went to zero. So before 2008, there were some funds, or there were some pension funds, insurance companies, some hedge funds, or other type of funds. They promised a, a greater return because before 2008, interest rates were around 4-5%, but after 2008, it dropped to zero. So when interest rates are at 4-5%, generating 8-9% return for a bond manager or for a pension fund is somewhat uh, a doable task. But what happened after 2008 is they promised the return of 8-9%, but essentially because federal interest rates went to zero, uh, generating 8-9% returns were like it was not as easy as it was before 2008. Now uh, this gave a rise to private credit. So what is private credit? Private credit is just lending without a bank. So there are three ways in I'm talking about debt specifically through which a bank can raise money. Sorry, a company can raise money. The first is I can go to a bank. Let's say I run a company A. I can go to a bank and ask for a loan. But I am a startup. My balance sheet is not healthy, and these bank guys, as regulations have been much more stringent, and so because of that, they can't give me a loan because I come under risky loans. Now, because I am a startup, I cannot go to public markets. Or let's say I am a publicly listed company, but still public issuing public bonds takes lots and lots of time, and you need to have a credit rating. So getting a credit rating and all that stuff is very time consuming. Now, apart from these two options, there came this thing called as private credit fund. Uh, It was direct, flexible, and fast. Understand this thing, like a very easy example would be, uh, for example, you want to take a home loan and you go to SBI, or let's not take the name, you go to some of the government's backed bank. You know how much time do they require to give you loans? They will take a lot of time, like around 1 to 2 months time to give you a loan on your house to buy a house. Uh, Now, for the people who do not have the, let's say, credit score or the things which are required to take a housing loan from a bank, what they do, they also want to buy a house. They go to some NBFCs like Bajaj Finance or like some other companies. So there, what they can do is they get this loan very easily as compared to bank. So this private credit fund is somewhat similar, where uh, like the due delegations and whatnot, the criteria to give you a loan is not very much harsh as compared to public bonds and bank loan. So that's why I, as a company owner, go to these guys. But these guys are also giving me loans at a higher interest rate at around 8% to 12% rate. So, as I was talking about, the forces behind the private credit market, which exploded, is basically banks backed away. After 2008, they were not allowed to give companies loans. Uh, so banks backed away, investors needed yield, and borrowers wanted speed. All these three factors pushed this, or let's say, fueled private credit market from around $450 billion in 2010 to almost like $2.8 trillion in, let's say, 2025 or 2026, early 2026. So it caused around 6x growth. Yeah. Now coming to, I hope you have understand till now why private credit went like the growth of private credit happened so crazy, and what is private credit and whatnot. So coming to how does a private credit fund works? So basically, let's say you are an investor. You are an investor who has invested around, let's say, $1 million. Where would you invest these $1 million? You have these three, four options. First is pension, insurance, and family offices. Now, what do these guys do? These guys pool in and they create a fund, and this is called as private credit fund. And they make a like a good amount, like let's say $5 billion, and now they start to lend this $5 billion at a direct loan at interest rates of 8 to 12%. So when this happens, uh, usually the usually this thing, for example, this fund is called as a BDC, Business Development Company. So this fund, let's say this is a BDC of BlackRock. BlackRock. So this they have collected they have collected $5 billion. So their AUM has become $5 billion, and now they have started to like give loans to companies who want uh, like quickly, and they do not care about interest rates. So they start to lend money, and the fourth step is when they lend money, usually they give quarterly payout as cash. So to these investors, like to me, or to pension fund houses or insurance funds or the family offices. So the payout of this fund happens quarterly. And keep in mind that this fund charges around 1 to 2% per annum, which is basically the total. It will depend. Like sometimes it is charged on AUM, basically asset under management. Sometimes it is charged, let's say, on the returns which they make. So it depends how it is structured, but in general, it is charged at 1 to 2%. So these so far, I think you guys might be thinking that, yeah, this private credit thing is looking good. It is giving me 8 to 12% returns. versus like 2 to 3% returns on bonds in a zero interest rate world. So in a zero interest rate world, earning 8 to 12% is a good thing. Also, most of these private credit funds are floating rates. So if interest rates rise, the loan rates will also rise, and essentially you will be getting you are basically hedged against inflation in this type of private credit funds. But this private credit funds, as I was talking about, the price discovery part is generally dependent on the fund managers. So whoever is managing the fund, they calculate NAV of that fund and they give me this NAV. Now, as I was explaining here, basically the private credit fund is lending uh, money to companies. So the asset for them is loans, and these loans are not highly liquid. These are very illiquid. So these smooth prices which you see in private credit funds is generally because uh, the price discovery which is done usually by the fund managers, and the high yields are generally given as a compensation because it is you have a lockup. So the quarterly cash which I was talking about, let's say I'm an investor in a private credit fund, but I want to withdraw my somewhat. Yeah, I need my money back. So I want to withdraw, let's say 10% of that from that fund. Uh, the liquidity lockups are also there. So you can withdraw 4 times per year. So 4 times per year, basically you can withdraw in every quarter. But let's say that like me, there are more people who want to withdraw X amount of money. Then what happens is if the fund is not able to uh, give me back my money, there is a term called as gate. So usually the gate is 5%. So if the fund is around $100 billion and they receive redemptions worth or more than like 5 billion, like let's say 6 billion, they will essentially pay out 5 billion only, and they will limit my redemptions. So this is also one of the cases here in private credit. Basically, liquidity is very less. There are cases where these private credit funds uh, try to wrap up the loans in a, let's say, a publicly traded vehicle by doing some asset-backed securities, like I was explaining in the last session about the ABS, which Leden has done. But usually these securities have very thinly traded volumes, and it is not very liquid. So yeah, the returns are coming at a cost, and it's not basically the redemptions are not guaranteed uh, because of the gate. If the fund redemptions cross 5%, then essentially you will not get the amount of money which you have requested. So this is what the problem looks like. Basically, this is called as liquidity mismatch. The fund promises you the access to your money, but the underlying loans which the private credit fund has cannot be sold very quickly because in general funds might be 5-year loans, 10-year loans. We don't know what exactly the structure is. So this is liquidity mismatch. Like you are promised that you can withdraw 4 times in a year, but the loans are like uh, the time horizon for loans is 5 years. So this is liquidity mismatch. And basically, because of this, what is happening or what is happening right now is this thing is happening. Selling early would require a big price discount because these private credit funds have also to sell these loans at a discount to a hedge fund who is trying to arbitrage. Uh, so that's the reason why they cannot liquidate fast and you cannot get your requested amount of money back. There's a case study, I think, yeah, the next slide. So, what is happening with BlackRock's, Blackstone, and Blue Owls of the world? So, basically, these three are one of the biggest private credit funds, and also something has happened with these funds recently. So, now, till now, if you have any doubts, please ask. Otherwise, I will continue to the example.
These lockout like 5% redemption. These are like said in advance to the investors, right? It is not like they are informed later. So
Yeah, yeah. But
why?
this is true that they are, it is written in the document, but this is the first time where it's happening that like the redemption requests are going above 5%. So it is the first time where the private credit funds are getting tested.
No, they are doing like they are not allowing withdrawal as per the document, like as per the
Yeah, yeah, yeah.
agreement, right?
Yeah,
So that it is nothing
yeah.
wrong. Like what happened in Twitter and
Nothing
other
wrong.
places was that it was
Yeah,
showed as that they have like not fulfilling their promise or they have failed on
yeah.
that promise, something like that. But that is not the case actually.
Mm.
The investors knew what the risks were, and they it was already mentioned that above 5% redemption, it will not be like there. Basically, there will be a mismatch between your funds raised and the products which you are taken, like the loans which you have given. So it will not never it will not honor it beyond 5%. That was clearly written. So basically, it is
Yeah,
not
yeah, yeah.
But
like default or something like that. Like back the newspapers and the news articles which came, it was like BlackRock defaulted on their funds. So it is not that case, I think.
So basically, I understood what you are trying to say, but these 5% redemptions also are not happening at NAV. That's the problem there. So I'm not saying in all the cases, but in some of the cases, the NAV is trading at a 30% discount. So uh, you are right, partially, partially. So the things are gray here. I mean, the redemptions which these private credit funds are facing right now, they have not faced in the entire history from 2008 to till now. So yeah, they are getting tested, and yeah, that's the problem because loans are illiquid, and if I want to like my investors want to redeem the capital, basically what I as a private credit fund manager do is sell that loans, wrapping up with a publicly traded or set up an SPV, then wrap up that basically some kind of loans and list it as a ABS or whatever asset-backed security, and try to get some like publicly traded, try to get it publicly traded, and from that I can do my redemptions. So there are some examples where, let's say I wanted to withdraw 1 million, but because of all these things, my NAV was 1 million before I put my withdrawal request, but after withdrawal requests have been taken into, that NAV's value dropped 30%. So because of this, essentially, I was not able to withdraw my 1 million as promised. So yeah.
Okay.
Any more questions?
But but the
So this, yeah,
NAV.
this 5% cap.
Yeah, go ahead, Yashwar.
So this 5%, are they going to like deploy the next 5% of the cash which people have asked for the like withdraw for the like in monthly basis or quarterly or annual basis? What are the like terms and conditions for this 5%?
So first of all, I will talk about like redemptions. Redemptions. So basically, you can only withdraw 4 times a year, 4 times. On top of that, this 5% gate is applied. So the first thing is you can only withdraw 4 times a year. And on top of that, if the redemption requests go above 5% of the total AUM of the fund, then you are only able to withdraw like the 5%. So this is on top, 5% gate is on top of the 4 times withdrawal which you can do
Like in 90 days or per annum?
in 90 days usually.
Yeah, I had one question regarding this. So you are telling that AUM declined by 30%. So it is
Yeah,
not because suddenly people have started withdrawing. It is because the loan which was given, that itself is not recoverable or it has collapsed because of the
mm,
current
yeah,
situation.
yep. Now you are getting to a point where we compare like Bitcoin as a collateral vs versus loans as a collateral. So because loans are illiquid, like the NAV started to collapse. You are right there.
Yeah. Okay.
Any more questions?
No, no, I'm done. You can go ahead.
Yeah, yeah, sure. So now coming to what exactly happened with these companies or the private credit funds like BlackRock, Blackstone, and Blue Owl is all restricted how much money investors could take out, and basically gate started to kicking because this BlackRock fund is about $26 billion, and the redemption request which they got is around $1.2 billion. So it comes to nearly 9.3% of the total fund. Now, what they have done is on a overall fund level basis, I'm not talking about a personal individual basis. Out of this 1.2 billion, they have paid around 600 million, but like essentially the investor had to sell more number of NAVs to recover this 600 million because the NAV traded at a 30% discount after this redemption request. So this happened with BlackRock's H-Lend fund. Then coming to Blackstone BDC, as I was explaining, basically these private credit funds are registered as business development companies. So it's similar to REIT. Like I'm not sure if I have talked about REIT. I think we have talked about REIT in the MSCI thing, MSCI. So when we were discussing about why are BTCTCs getting removed from the MSCI indexes at that point in time. I think I talked about these REITs, so real estate investment trusts. So these BDCs are similar to REITs. In case of REITs, they have real estate in their fund, and in case of BDCs, they have loans. So similar things. Now, what happened here is uh, they also had a 5% gate in their BDC, but they received 7% redemption requests. And because of this, like what they had to do is, first of all, to investors cannot redeem 7%. Investors have to redeem on a fund level basis 5%. So to fund these 5% also, these companies have to put in their company's funds and employees' funds as well. So this was critical. Like I have not seen an example where you are asking funds from your employees to fulfill your investors' demands. So I thought it was like crazy. I read about it first time. I'm not sure like how does these things work, but yeah, this is what happened. And in case of Blue Owl, the thing which happened is crazy. Like these 5% gate, they disallowed all the 5% gate and they shifted. Uh, Basically, the redemption was asked, but what happened is you cannot redeem now. They said that we'll return your capital when after the whatever time period which you have subscribed to be in the fund. So let's say I have subscribed it for or my maturity of my product happens after 5 years. So I will be getting redemptions are not happening. $0. I will get my whatever investments plus return in after the maturity. So essentially, they closed redemption windows, and that's why you are seeing this whole scenario on X where people are speculating about there is something lacking or something breaking in these private credit funds. Now, coming to as Amol was talking about all these things like hidden valuations, PIK, I will come to each and every category. All these things were already documented in their like basically documents which you sign when you enter into agreements with private credit funds. But these cracks are being tested first time since like the launch of private credit funds, I can say, or since they started to be bigger. As I was talking about, like in 2010, it was 450 billion, and now the market size is around 2.8 trillion. So, like the growth has become like crazy, and throughout this period from 2010 to 2026, uh, like these scenarios have never happened, but this is the first time where we are seeing some cracks as I mean, these cracks are already, I mean, written in the documents, but yeah, um, the point here is uh, anyone on X or, for example, in our session, what I am trying to convey is basically loan as collateral versus Bitcoin as collateral. So the storytelling which I will do is like I will brag about loans and I will tell good things about Bitcoin. So that's why these cracks and whatnot you are seeing on X. But in general, I think, yeah, compared to loans, Bitcoin is much better collateral. So let us come to the point here. The first thing, hidden valuations. As I was talking about, the loans are priced by the fund manager, not by market. These private credit funds are private, they are not listed publicly. So the pricing mechanism is done by the fund managers. Amol, to your question, earlier questions, what might have happened? I'm just speculating here. Like these fund managers might have uh, reported higher NAV values than they should be. So this might be the case because of hidden valuations. Like they are the controller of NAV. So wow, like loan is not being priced by the market. So I'm sure there are some mechanisms which mechanisms to value loans, but still it is in control of fund managers. So they might have reported higher NAVs before throughout these let's say bull market of private credit funds from 2010 to I would say 2024 because these cracks have started from late 2025s or middle of 2025. First thing, hidden valuations. I talked about it. Then comes PIK loans, payment in kind. So, as I was talking about, like you receive four times, uh, four times interest per year in your in private credit funds. So, uh, there are cases where they said that we are paying you in kind and not in cash. So, what does this mean? Is if a borrower is struggling to pay cash, what they do is essentially they borrow more debt and instead of paying cash, they will renegotiate and uh, like tell you like I'm taking more loans and like pay your borrowers with this or promise them later. So all these things or get my or I'm paying with my equities or paying with my let's say convertible bonds. So all these things happen in this pay in kind. So all of these methods happen in PIK. Now, covenant erosions. So, what is a covenant? Covenant is basically a rule which the borrower must follow. But as I was talking about, these private credit funds have grown from nearly a $450 billion to $2.8 trillion market. Because of this, what happened? Many players jumped into the market, and to win deals, they started to what I can say the covenants which were harsh on the borrower side in the earlier days, let's say in 2010s, these rules or these covenants started to become over time they started to become dilutive, like lesser harsh to the borrowers, which means less protection for the lenders. So these things happen because everybody wants to do business, and if I'm not growing my AUM, then how can I basically grow? So these things happen, covenant erosions. Then comes concentration risk. Now this thing is not being like this thing is also being discussed in the articles or on X, where in case in specific case of uh, BlackRock, 20% of the loans which the private credit fund has given is has an exposure to software and tech. Now, as you guys know, because of AI disruption which is happening right now, the revenue model of SaaS companies is questionable. Software as a service is questionable. Like already we are seeing layoffs and whatnot. I'm not an expert there, but uh, like I'm sure like there will be less businesses or the business models of these SaaS companies going to get broken. So if the business model is going to get broken, then revenue models are going to get broken. And if revenue models get broken, then how are they going to pay back my loans for a private credit fund? So this is a concentration risk. Then refinancing involves. Now, as we all know, there is a thing which is called as refinance, which is a like a beautiful thing for TradFi is if you borrow, let's say $1 billion from market, essentially you are never going to repay this. Like you will be just refinancing it after every 5 years. One like let's say 1, 2, 3, 4, 5. Here on the fifth year, you will refinance. You will refinance your loan. So the fifth thing is the refinancing wall is coming closer, is coming due. So all these things are happening at the same time, and because of this, pressure is being created into private credit. Till now, everything clear? Yep, I think yes. So now I'm coming to Bitcoin-backed securities or corporate securities, basically digital credit, like products like STRC, SETA, STRF, and whatnot. So all these products are like Bitcoin-backed credit, sort of Bitcoin-backed credit. So these are basically preferred stocks. I think most of us know what this is, but still, if you are listening for the first time, these are perpetual preferreds. So in this case, maturity never happens. So if I borrow 1 billion, I'm not going to refinance that 1 billion. It is I'm borrowing it for like eternity, but I will be paying you interest every like let's say in case of STRC 11.5% per annum. So I will be paying interest like going concern till my company is there. So this is the case. Now, as we all know, all these products like STRC, SETA, STRF are being launched by Bitcoin treasury companies, and the collateral. Now, here I want to talk about collateral. Collateral is not direct, like it is just a claim. I mean, in the case of private credit, the collateral is there, like it is pegged to the, let's say, if I'm borrowing, my land is pegged, or my land is mortgaged, or my like machinery is mortgaged. But in case of perpetual preferred, uh, the Bitcoin is I mean, people talk about it is acting as a collateral, but it is not like tied like a collateral. Basically, uh, you will have a claim on it, but on top of that, the first people who will have a claim is convertible bond holders. So before STRC and STRF, like these are the people who will be able to get claims, but over time, what will happen? These bonds will get equitized. Equitized. So as and when these bonds get equitized, the only thing that is left is this. In case of SATA, SATA is one of the instrument launched by Strive, a publicly traded Bitcoin treasury company. So in their balance sheet, it is very simple. Like they only have SATA, they do not have anything else in the capital stack. So even if Bitcoin is not kept as a collateral, in case of bankruptcy, SETA holders uh, will be standing first in line, um, uh, before like they will be getting paid ahead of ASST, so the common stockholders. In case of STRC, STRF, like these guys are standing ahead in line as compared to MSTR shareholders. So the Bitcoin here is not directly collateralized or not directly like kept as a collateral, but in case of bankruptcy, yeah, you will be getting Bitcoin. You will be getting paid first. So I will be talking as Bitcoin is kept as a collateral, but still, for explanation, I have explained you. Uh, Now, as we all know, Bitcoin is highly liquid. It's tradable 24/7, 365, and because of all these things, and we also know some of the publicly traded companies have also, uh, what I can say, have also released their public addresses of Bitcoin. So the transparency which is there in case of Bitcoin-backed securities when compared to private credit funds, is way higher. So because it is way higher, can these private credit funds or can the cracks which are happening in $2.8 trillion market find a way here? That's the big question. Like, do these funds will consider taking some exposure in this Bitcoin-backed credit securities? Because the yield promise is somewhat similar, I can say. Like STRC is yielding 11.5%, where a private credit fund will give you like 8 to 12%. So the it is fitting into their what I can say return expectations. On the risk side, I think one more thing which I wanted to talk about is the Bitcoin coverage. Is if there is $1 billion, sorry, if there is uh, $1 billion of STRC issued, uh, Sailor has kept or the BTC rating for it is around 4.5 times as of current price. So Bitcoin is down around 50% from all-time highs, and still STRC is 4.5 times. So for every $1 billion of STRC, $4.5 billion of Bitcoin is sitting in the balance sheet. So it's highly over collateralized. Now, because of this, I think risk reward in the digital credit products is making sense uh, from whatever I have done some research. So basically, this is the point why I think that there might be, or why people around Bitcoin treasuries are thinking that what if some funds are, we attract some funds from this private credit market? Because before that, what we were talking about bond market and like money market funds. But these markets are like highly sophisticated, highly like mandates will be pretty strong. But in case of private credit, because the investor want higher yield, the mandates for these private credit funds might not be as harsh as the bond market funds or as the money market funds. So there is a more chance of private credit funds finding a way in this Bitcoin-backed credit products than directly bond market guys investing in these products. Now, as I was talking about, Bitcoin investor understand this than anybody else because Bitcoin is transparent and on-chain tracking. Like we know, like MSTR has not released their addresses, but there are people out there in the market who have tracked essentially all the Bitcoins which strategy holds. So Bitcoin is transparent, it trades 24/7, then it is highly volatile, but Bitcoin backed credit has what I can say, to be specific, STRC has diminished volatility as compared to all other products. like its 30-day volatility is around 4%. So they have achieved what they were thinking. And yeah, Bitcoin treasury companies as well who are issuing these Bitcoin-backed credit products. Now, coming to a table of comparison where uh, comparing private credit directly with Bitcoin-backed credit or digital credit is private credit. Can you sell today? No. Quarterly windows. Bitcoin-backed credit, yes, you can sell like whenever the markets are open. How is it priced? Fund is sets the price quarterly. So NAV is adjusted every quarter. And in Bitcoin bracket, market prices it every second when it is traded. What is the collateral? Collateral is corporate loans. They generally tend to be opaque. In case of Bitcoin bracket, Bitcoin is collateral. Volatility. It appears smooth, like give more focus like on appears because the NAV is reported by fund managers and this removes volatility. So yeah, it appears smooth, but in case of Bitcoin backed credit, it's visible to you all the time, like whenever it is traded because it's traded in the public market. So then comes income reliability. It's often strong and contractual. In case of Bitcoin backed credit, it varies by instrument to instrument. And also, I would say uh, Bitcoin backed credit is not contractual. So, one point which is against Bitcoin backed credit is because the payments are not contractual, the payments are dividends basically. So, unless and until you think that a particular company will not stop dividends, the so basically trust is more when you are buying Bitcoin backed credit instruments as compared to private credit instruments because the payments are contractual and you can go into the court if they deny you payments and do bankruptcy procedures. So because Bitcoin backed credit is not contractual. That is one of the reasons that income reliability might be questioned in the short term, but as and when the market matures, we might see like much more inflow. Bitcoin exposure none, direct and significant. Who controls risk? Fund managers discretion and market plus issuer discretion. So this is like a side by side comparison. Then talking about what are the risks in Bitcoin backed trade. Just because we say it's Bitcoin backed trade, it's not risk free, right? So Bitcoin price risks. What happen? What if Bitcoin drops? So as we all know, Bitcoin is highly volatile. Your preferred shares or notes might lose half of their value. Then there is also like interest rate risk. But all these risks are also there in what I can say, private credit funds as well. So yeah. Then capital market dependence. Now, as you all know, the dividends of these Bitcoin backed credit products is generally given by issuing a security like STRC dividend is paid by issuing MSTR common in most cases. So, like capital market dependence is a thing. Then reflexivity, like what if BTC falls, company stock falls, it goes under and like one times NAV, how are you going to fund dividends and whatnot? So for this, like companies have this dividend reserve, which strategy has around 2.5 years. Strive has around, uh, I think, 12 to 18 months. Then governance and management risk, it's pretty common. And yeah, limited track record. This is one of the main risks. Like it is like the Bitcoin backed credit market is very nascent in its stage. Like it's just, I think, 1 year old. So yeah. Then as Amol was talking about that private credit funds and Bitcoin backed credit are like basically private credit funds is totally different. Like these guys are attracting totally different investor, to be specific. Like some investors are same like insurance companies and pension funds. Like these have long-term liabilities, but in general, who will be investing in Bitcoin backed credit? Basically, if you think that Bitcoin is going to go up in value for in the long term, when you that's when you will consider to buy like these Bitcoin backed credit products. So yeah, then comes like uh, so basically what this slide is trying to explain is uh, these these guys might come here but may not. Like this will depend on uh, uh, like how much adoption happens in case of Bitcoin. Like the trend is clear, like institutions are adopting Bitcoin in the US. So these guys might hop into Bitcoin backed credit, but yeah, no one knows what will happen. Then last slide, five things to walk away in the with the session as Amol was talking about. Private credit is not broken, but it has some structural flaws. So yeah, this is one of the things. Then the gates were the symptom, not the disease. So gates were already written in the documents. It's not something new. Then in case of Bitcoin-backed securities, it solves transparency problem, which is completely lacking in private credit funds. It is completely opaque there. But with BTC-backed trade products, it introduces Bitcoin price risk and the management risk of the specific company and whatnot. Then there might be happening some reallocation, but it's not a revolution because this thing is in a nascent stage.